We're going to take some time now to discuss trading. We're going to concentrate on options trading because it's the most difficult vehicle to trade, the option. First, I'd like to give you an indication, at least as I see it, of how far it is possible for a society to take a concept like this. I mean, we've been in a bull market for quite a while now, and a bull market generates all kinds of new ideas, such as options or futures contracts on indexes, things that never existed before. Program trading and everything. I'd like to read something to you that is an opinion written by a lawyer about the legal aspects of dealing in options, just to show you how intricate things can get. Here's what he wrote. As to whether the regulation is applicable to option contracts, the opinions of experts diverge widely. All legal experts hold that the regulation is applicable to both the seller and the buyer of the contract. In practice, however, the judges have often decided differently, always freeing the buyer from the liability while often holding the seller to the contract. If the assumption is true that the regulation applies to both seller and purchaser, I can rely on it if, as a trader, I have received call premiums and am forced to deliver the stocks on the day of settlement. If, on the contrary, the opinion is correct that it applies only to the seller, the regulation will be of no use to me as a person wanting to seek shelter when I receive call premiums, for in this case I am in fact a seller. But it will help me if I have received a put premium, as I am then the buyer of stocks. However, if the payer of a put premium possesses the stocks on the day of the negotiation of the contract so that he could offer to make delivery to me and have them transferred to my account within 2 weeks after the offer, it is unlikely that in such a situation, embarrassing though it might be to me, the regulation can be appealed to. According to the opinion of some people, it is sufficient if the payer of the premium possesses the shares on the day when he declares himself ready to make the delivery and not already on the day when he entered into the premium contract in order to make all objections on grounds of the regulation ineffective. Got it? There's a quiz on this one, too. Isn't that something? All that energy put into the idea of trading options. And how long have options been around? When did they first come out? Anybody remember? Early 70s? Well, you might be interested to know that this was written in 1688 about the Amsterdam Stock Exchange. So options have been around a long time, and people have been losing money in them for a long time, too. Speaking of losing money in options, you've heard the old cliche, buy low, sell high. Well, I'm afraid that in the world of options, even that simple adage doesn't work. If you buy low, you may not make money. If you sell high, you may not make money. Let's look at an example of this. Do you remember when the market crashed in 1986? It's erased from most people's memory since 1987 occurred. But in September of that year, the market had a very severe drop. Now, let's suppose we had two geniuses operating in the market at that time, two market timing geniuses. There they are. Now, one of them has a wonderful model, particularly for picking tops. And on the exact day of the peak, September the 5th of 1986, he says, this is a top. I am going to buy October OEX puts. And sure enough, the market starts to collapse. And he's making money like crazy. The Dow at that time was 1,922 and moved rapidly lower. And this man is long puts and he's pretty happy. Now, out of the woodwork comes another genius. This guy has a terrific market timing model also. He spent most of his time trying to figure out how to pick bottoms, and he identifies the low of the correction to the hour. And he buys that low by purchasing OEX October 225 calls. The Dow at that time was 1739. In other words, a 10% collapse. Well, then, of course, it started to move upward as it headed into October. The question is, how much money did each man make? The answer is zero, not a dime. Actually, I should draw it like this, because that's what it feels like when your option expires worthless. And in this case, that's just what happened, because on the exact close of the Friday when this option expired, the October 225, the market closed at 225 on the OEX index. So both the put that this gentleman purchased and the call that this man bought went out worth nothing. And notice both of them were right on the trend. This guy sold high. This guy bought low. The market was higher after this guy bought his call. The market was lower after this one bought his put. And yet they lost everything. And of course the reason is that there is a time premium in the price of an option. You pay for the privilege of buying it by paying a little bit extra to someone above the value of the strike price so that his risk is minimized and yours is increased to that extent. Well, I'd like to discuss another type of genius. This is a guy who has a method that's so good that it doubles his money in options 9 out of 10 times. With those odds, he's extremely excited. He's worked on this for a decade. He's got $50,000 that he feels he can use to speculate in this area. So he pulls the $50,000 out of the bank and he puts it into his account. He goes long calls, and sure enough, at the end of the trade, his account is worth $100,000. He says, this is terrific. So he takes his $100,000, and this time his method says, we want you to go long puts. So he buys puts. Sure enough, trade goes out perfectly well. He's now worth $200,000. His next trade, he's worth $400,000, then $800,000. My question to you is, how much money does he have left after 10 trades? How much money has he made after 10 trades? You got it. He hasn't got a nickel. He's got this much. What was his mistake? He kept putting it all in. And options have a tendency to go out worthless. This must be taken into account if you want to be a successful options trader. The most successful options traders take into account that fact. They say, I know that a lot of the purchases I make in options are going to lose money. Now today I'm going to talk about the buy side of options. That's where the leverage is, and that's where if you're right on the market you can make 10 times on your money or even more if the move is right. There are very sophisticated writing programs whereby you'll be selling options either against positions or naked. I'm not going to discuss those today because we're going to be talking about highly leveraged vehicles for speculation and taking that one entry which might be worth more to you than just about any other vehicle could produce. Options are tough. One person once described them as trying to play three-dimensional chess. There are a lot of things to think about. Most people, as I said, just think about buying low and selling high and think they can reduce it to one single dimension. However, there are a lot of things you have to consider before taking a position in an option. And the first is the price movement that you expect. You don't necessarily have to have a method that is going to predict exactly where the market is going, but it must be strong enough to give you a high probability outcome for a move of a certain percent. Obviously, if you have an approach that says it's time to buy but doesn't tell you whether the rally will be 2 points or 200, it's no good. But if on average your method is saying you can expect a 10% move out of this, at least a high percentage of the time, then at least you've got something that you can gain a perspective with. It'll allow you to trade the kind of option you need to trade. Your system then should imply a minimum size move. Okay, that's not enough. In fact, the next concern perhaps is the most important, and that is timing the entry. I'm not merely referring, again, to buying low or selling high. What I'm talking about is timing the entry relative to the action of the market at the moment. The most successful options traders buy calls when the market is collapsing, is already deeply in an oversold position, but at the moment is falling apart, ticks are minus 650, and everyone else is panicked. That is when people are throwing options overboard without regard to price, and if you're there with a little basket ready to catch them, you're getting them very cheap. Let's suppose the Dow Industrial Average is coming down very hard one afternoon, and just to pick a number, it's at about 2,000, but falling with ticks at minus 650. And an option is trading at 1.5 under extreme pressure. If the market makes a low a half an hour later and starts to rally, and by the time it's rallying, ticks are plus 400, and the market is back at exactly the same level, 2,000, that option could well be worth 2.5. And when you try to buy it, it'll be 5/8, 3/4, and ultimately you may end up paying almost 100% more for the option, even though the market was at the same level. So you have to time your entry to purchase calls into weakness or purchase puts into market strength. It's critical. Now, just as important is trying to anticipate the time length of the move. If you need the market to reach a certain level by the 3rd week of January, and it doesn't do it until the 4th week, and you've got out-of-the-money options or on-the-money options, they're going to go out worthless or you're going to lose money. So you have to have some kind of perspective on how long it will take the market to move, say, the 10% that your model suggests the market should move. If it's going to happen in 3 days, that means one thing. If it's going to take 6 months, that might mean purchasing an option a bit further out. Well, even that isn't quite enough. I think it's very important to have some idea of what the momentum of the move will be like. It's different if you're expecting the market to jump 50 points, let's say in a 3rd wave in an impulse, and perhaps struggle higher 50 points in a 4th wave of a C of a major bear market. Because momentum has a lot to do with the way people value options. If the market is soaring, say for the 3rd day, and opens higher and is moving, people factor that into their psychology. And they start projecting the present and the recent past into the future. And they say, man, if the market continues like this option is going to be worth 300 by a week from Tuesday. So naturally they're bidding it up and bidding it up. And it's going to be worth more than if the market moved to the same level but did it on very weak momentum, a lot of choppiness, moves back and forth, keeping people skeptical and so on all the way up. It will be valued differently. The premium will be much smaller. This is more difficult to get a grasp of, but if you know some Elliott, sometimes you can get a handle on this as well. And that is, what kind of psychology will attend the move? A good example is in a wave 2 situation coming off of a high. If the market has come down in a first wave and is rallying in a second wave, people tend to be extremely bullish because the preceding move was a bull market move. And they look at wave 2 as a continuation of the bull market. The guy who was smart enough to buy calls at the bottom of wave 1, looking for a rally in wave 2, he's done his analysis, he counted 5 waves down, he said there's going to be a rally here and I can make money in some options. Even if the market rallies sharply, if he hasn't bet on the psychology, he may not have realized that those calls were already way overpriced because people were buying every pullback imaginable, and when the wave 2 gets underway, there just aren't any buyers left. And the few sellers that there are keeping the price from going much higher. It's amazing how many times you can buy a call even near a low and watch the market go up and the price of the option doesn't move because the psychology is not moving with it. It's already moved. So the best time to enter a position is when you feel that the psychology will change in the direction of your speculation. Well, that's 5 things to worry about. There's an overall answer to these 5 questions, and that is very simply, study your market. A lot of people think they can trade stock index options by studying the behavior of stock indexes. It sounds logical, but it really doesn't work. At the end of the year, they look at their balance sheet and find out they haven't made any money. And they may have called the market pretty well, or called the index pretty well. But what they failed to investigate was how options behave. That's what I'd like to address now. Let's take a look at a typical behavior pattern for an option. This diagram is modeled after the actual prices of options. This is a rough depiction of what the market did in 1984 from the July low going into the end of the year. And what we'll be tracking here is the price of the OEX November 175 call through its stages of movement. Well, let's keep in mind that coming down from the high, this particular option has probably been losing a good deal of value. The market has been declining virtually all year, starting from a January top. People are getting discouraged and worried. So the option has been under a lot of pressure. It won't have a lot of premium. It's pretty cheap. It doesn't necessarily make it a buy, but it doesn't have a lot of premium at the moment. It's something you're watching, and you may be keeping an eye on the market at this time. The market is still falling, and at this particular point falls to a new low for the year. Well, the pressure on the option is intense because, of course, as we've already talked about, people's psychology is such that on a new low, particularly well into a bear market, they are very pessimistic. They see no reason why they should own this particular call. Matter of fact, some people may be selling it in anticipation of it going to a half or zero. Now, the most interesting thing happens right in this period here with waves 1 and 2. The market makes its wave 1 up. Remember the psychology of a first wave. People generally feel that a wave 1 up is just a rebound in the preceding bear market, that old bear market really is still in force, and this is just a rally. It's a rally to get out on. And you know what the people who own this option are doing? They're getting out. They're selling it to whoever will buy it, and that keeps the value very compressed. Don't forget, strike price is way up here. So in order to feel that this option is going to go out worth anything at all, you have to have some kind of conviction that the market can rally this far at least. Well, then comes wave 2. It's a minor pullback, hardly noticeable, and yet the option is pummeled because of the psychology in a wave 2. Wave 2 psychology is that the old bear market has resumed. This is when the put-call ratios are the highest. People are buying puts and selling calls, and this happens to the price. Notice that the price here is lower than the price at the actual bottom. Then comes wave 3. At some point along wave 3 is the point of recognition. This option starts leaping, probably in large increments, not 1/8 at a time. And finally there's this middle portion where all of the trend followers who keep moving averages get buy signals. So right here the option leaps from probably somewhere around 3 or 2 3/4 all the way up to 6 and is still flying as the market is now moving vertically to the upside. Now the trend follower is telling himself, I have a method on the market, and this method tells me that market prices are going higher. And he's right. But it doesn't necessarily mean that he can therefore buy options and make money. As the option follows the market, it moves up to 7, 8, 9, and finally peaks with the first price top at 10. The market has a reaction, and all the people who jumped on board this late, of course, are quite worried, and the option gets settled back as they feel, well, gee, maybe I bought a spike top. But you see, it's pretty minor pullback. It only moves to 8. Then the market rallies, hits a new high, actually crosses into strike. See, now this option actually has some real value to it. And yet, the option peaks at 10, not higher. The market's higher, but the option didn't go higher. Why is this? Here's why. You see the slope of that move? the people who are buying options there are projecting that speed into the future and saying, man, if this continues, the option is going so high, it's still a bargain at $8, $9, or $10. Well, even though the market is higher, these people are only projecting that slope into the future. They're saying, well, this market's still flying like crazy, not quite with the acceleration it had before, but if it continues at that angle for the next month and a half, this option is still a bargain at $8, $9, or $10. Then the market has another reaction. Notice it doesn't fall below that low, but the option does. This time it's 7.5. The market hits another new high, and this time it's only worth 9. Now there's another factor coming into play. Not only is this slope becoming less, and therefore the natural human tendency to project it into the future is showing a lesser slope to rely on, but some of these technicians who are short-term oriented and keep rates of change are noticing something. The market is making new highs, but that speed of price change is beginning to slow. They're getting sell signals, divergences, and so on, and they're starting to bail out of whatever they've got ahead of the game. These are the professionals and the smart guys who see that the upward movement is slowing. All of a sudden, sure enough, the market has a very sharp reaction. Notice it comes right back into the same area that these prices of 8 and 7.5 generated earlier. This time, however, the option is worth 4. Is there any other factor starting to come into play? Time. Clock's just doing this. Tick, 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 tick. And of course, now people are starting to worry. Well, gee, maybe this correction is ending, maybe it's over. But I know one thing, November is moving up fast. And the slope is slowing. And this time the option's only worth 4. Then the market rallies again. This time gets into the territory where it's actually worth something again, crosses the strike price, but the market peaks. This time the option is 5 1/8. Then comes a real drop, and you can see the option is finally being thrown out because people are now coming to the conclusion that it may not make it above strike by expiration day. It's 3 1/8 here, 1 7/8 here, and back to $0.50 there. Now, notice something. You see this guy with his trend following moving averages? He bought his options at 6 or maybe on the way up between 5.5 and 7 because he knew that the probabilities were powerful that the market was going to make a new high, and it did make a new high. What is his option worth here at the new high that he was projecting? Less than he paid for it. He has a loss. After commissions, he's got a loss of almost 20% here. Well, sure enough, when this reaction comes in, of course, the option falls to as little as a half. Now, what's interesting about that decline? Let's go back to our genius again. The guy who bought right here, either at the low at $1 or at the wave 2 low, he's actually lost money. He caught the low of the year in the market by his method, and he's losing money. What happens next? Well, the market stages a pretty sharp reversal off this low, but the option isn't moving. Because those people who didn't get out before, who bought a whole bunch at 5 or 8 or 7, all they want to do is get something back, and they're selling into this rally, and there aren't many people interested in buying it because some of these people are now looking at the Decembers or the Januaries so they can lose money in those. Well, the market continues to rally, and sure enough, it pushes above strike again, and now has an intrinsic value of 1 1/4 because it's 1 1/4 points above the strike price, and yet the option isn't going to reflect any premium because there's just not enough time left. It's worth 1 3/8. It will only go out with some value if it closes above the strike price. Well, the market has a minor reaction. An expiration day occurs right there, and the option is worth absolutely nothing. Now, this unfortunate occurrence can hurt even those people who correctly forecasted that this was the low of the year, that the market was about to embark on a multi-hundred-point rally, because it did eventually, out here in January, February. But they didn't take a lot of things into account that are peculiar to options. There's an old adage in the trading manuals that says, never lose a certain percent, always place a stop. Well, that's another difficulty with options. You can't place stops. And if you try, if you say, well, if it reaches a certain point, I will get out, you will be destroyed in a matter of days or weeks, because options are extremely volatile, as you can see on this particular picture. Well, what is the message of this type of behavior in terms of how you should be approaching the purchase of out-of-the-money or on-the-money options? I think the answer is you've got to know something about the wave principle and then time your entries according to it. Let's find out how much time it would have been worth trading an option on this entire chart, which covers about 6 months. It took me a long time, actually, to get over this problem. If you derive more pleasure out of having a confirmation slip dated and stamped the day or the hour of the low, then this is something the market's going to punish you for if you're going to trade options. Because the low is not necessarily the time when options are making their lowest price. Well, the best thing you could have done was to wait until wave 2 was in progress to purchase your option. The most phenomenal percentage gain came from the bottom of wave 2 to somewhere past the middle of wave 3. Now, the irony here is this is one of the easiest trades on this whole chart from an Elliott wave standpoint. The reason is that this upward movement subdivided on the hourly chart into how many waves? 5. It told you that the trend was likely reversing. When wave 2 came into play, it was only 3 waves. Options were getting cheaper and cheaper, and you had a good shot at making some money. No guarantee, but you had a very high probability based on the Elliott wave indications that something was changing. If you bought anywhere in this wave 2 and watched the market get past its middle point when it started gapping upward powerfully, you could have then sold them almost regardless of what your wave count was inside wave 3. Because whether it's worth 5, 6, 7, 9, or 10, anywhere in this upper range, the percentage gain was phenomenal. Holding from 6 to 10 wasn't even 100%, but from 5/8 or 7/8 or $1 up to 6 was a huge percentage gain. And that's why timing the entry is so important. If you wait and try to buy it, even at the same price level, but while the market is breaking out and reversing on very high ticks and so forth, you're going to pay perhaps $2 for the option, and if you get out at 6, hey, that's a nice gain, but it's nothing like buying it at 5/8. Well, what about the rest of the chart? My feeling about that is forget it. If you want to turn yourself into a professional options trader who's short-term oriented and trading all the time, that's one thing. But if most of the time you're going to take a conservative investor type approach, but you have some money set aside for those occasional times when a high percentage gain is possible, then this is the time to enter the market. And the same thing, of course, is true on the downside. A wave 2 up in an A wave or a C wave is an excellent time to buy puts. And anywhere into the time when the recognition stage that wave 3 is enforced and the bear market or the bull market has reasserted itself hits the general public, that's the time when you can just let it go at the market and forget about the trade afterwards. Well, there's a little more to it than that. As I said, volatility can be extremely high. Sometimes options can drop as much as, say, 50% in a matter of a couple of hours. Or for that matter, rise 100% in a couple of hours. This brings us to the question of money management. Personally, I think a good guideline is that you should never have more than 1/3 of your entire trading account involved in options at one time. When I was trading in the United States Trading Championship, I had a money management approach that worked for me, and I want to share it with you. Let's suppose, to make the figuring easy, that you have an account worth $100,000. Well, based on the 1/3 rule, you should never put more than $33,000 into a set of options at once. But let's assume that you're going to approach this even more conservatively and say, the most I will ever commit to an options position is $15,000. That means I can be dead wrong, regardless of how good my analysis is, several times before my account is in really big trouble. Because remember, the potential reward that you're shooting for is a several 100% gain at least. and all you need is one out of 3 or 1 out of 4 of those to make it worthwhile. Well, here's the way I used to approach things. If the market was dropping, let's say, into a point that satisfied me that an important reversal was going to take place. I didn't put the whole $15,000 in at once. The option I was interested in, let's say, at this point right here, was selling at $2. So I take $5,000 and put it into that option on the bid side as the market is coming down. And I've told myself, this is a good entry. I'm buying on weakness, not a bad entry. Just because my analysis tells me that this is a good time for a low was not enough reason for me to put the whole $15,000 in. So at that price, I bought 25 options. Let's suppose that the market does this and goes straight up from there on out. Terrific. Hey, I bought 25 options at $2, put in $5,000, sold them out at 6 or 8. I couldn't be happier. That's terrific. But let's suppose the market doesn't. As we all know, waves can extend, sometimes subdivide a little further. And don't forget, you can't be bailing out of this thing on weakness because it's probably going to drop very fast and give you a 50% loss before you know it. All of a sudden, the market subdivides its 5th wave a little bit further. So I hit another point and I say, gee, I don't want to bail out of here. All my indicators are bullish. The wave count's still saying this is a terrific time for a bottom. I really should do some more buying here. Now, I don't go out and buy 25 more options. I put in another $5,000 and buy 50 at 1. There. Now I'm up to 75 options. My average price is quite a bit less than 2. Let's suppose, as we just discussed, that the market does reverse here, but there's a wave 2 involved, and the options start getting even cheaper. So I put in a bid and I say, I can't believe anybody's going to do this, but if they do, I'll take another $5,000 worth of these at $0.50. And sure enough, somebody's out there and he's ready to panic. There's bad news coming out. You know, they announce another trade deficit or something from Argentina. So some guy who had 500 of the things said, oh, to heck with it. Never going to make a dime. He puts them in for sale at the market, and sure enough, you're in there on a good till canceled order at $0.50. So let's suppose you do get lucky this time. They trade at a half, and you put in another $5,000. You've just bought another 100. Let's suppose the market takes off then. Or at least rebounds for an hour and a half. Let's suppose you're still wrong on the major trend, but the market just rebounds. And that option goes from that extreme low of $0.50 back to 1. Well, you could sell every one of those 175 options out at $1 again and make money. You'd make $2,500 at that particular time because your position would then be worth $17,500 and you paid $15,000 for it. You have another option here. You could sell $10,000 worth, putting $10,000 back into your account. That returns you to your original $5,000 commitment. Now you're exposed down to your minimum level again, and you can breathe quite easily. And not only that, you still own 75 options. And your average price on them is 11/16 of a dollar, so you're at a profit. You could take either road, depending on what your analysis is suggesting that you do. What has happened to the guy who bought all of his options when he thought he recognized the low for the first time? He bought them all at 2, and he's got a 50% loss. And you're at a gain because you were using other people's psychology in your favor. Along with your analysis, you are now thinking more about how options behave and a little less about how the market behaves. You are putting in intelligent bids and picking up options cheap when other people were panicking or when the prices were getting listless and lower, even though your analysis may have indicated the low was passed, the low for the option wasn't, and you used it to your advantage. Even if you are so convinced the market's going to explode, you've never been this sure in your life, you can still opt to sell back down to the original $5,000 investment and say, if I'm right, hey, I'm still going to do well on this particular trade. If you will trade that way all the time, you notice you can even be wrong for quite a period of time, but you can continue to get yourself even again on those bounces. The one thing you cannot do is decide you're wrong while the market, in this particular case, is plummeting at some point. You can't bail out at that time. All the good options traders I know will force themselves to wait until strength returns in order to try to get out of options of this type. Now, when a case like this develops, I always say, we've done our hard work, now it's time for the market to do it. Once you've gone through all the terror involved, relax. Your method is saying there's a scream and rally going on. You got these at a very low price. You can now let the market do the work. You don't know if this option is going to go from your 11/16 average entry price to 1.5, 2, or 30. Anything is possible from this point out if your method is telling you there's a potential for, say, a 10% move in the market. You must let that one trade that's going to be big occur to make up for those 10 that force you to take small losses along the way. Now, let's take the worst case here, too, and say, well, the market went straight down from here and your original $5,000 investment goes to zero. You still only lost $5,000, you see. You involved $15,000 in that options market at one point, but you ended up losing $5,000 because you were willing to even back up to that level when the market rebounded. Now, you can avoid all of the problems we have just discussed if you'll do one thing when trading options, and that is only buy deep in the money options. Don't buy out of the monies. Don't buy on the monies. For those of you who don't understand, deep in the money options are those which already have a huge percentage of their value as intrinsic. In other words, if the OEX is at 240 and you own a 225 call, it is actually worth $15. If expiration day were tomorrow, they'd have to pay you $15 for it. Now, usually an option like that will sell for as much as 20, but the amount of additional premium contracts the more the intrinsic value is. So let's suppose you have an option whose intrinsic value is $30. You may find there's only $1 or $2 additional premium on the price. Now, out-of-the-money options are the biggest lure for most people. They look at them and say, gee, there's only $1 here. This is cheap. If the market goes up 3,000 points, I can make a lot of money. The hope is so big, it's almost like the lottery, you know. People say it's so big, it's worth a ticket. Of course, mathematically, it's not worth a ticket. Well, the same thing is true with options. They usually expire worthless, and you have to deal with what happens in between in order to make a profit. All of the 5 problems we discussed, plus the money management problems we discussed, for the most part, can be eliminated if you will concentrate only in deep in the money options. Most people can't stand doing it. They'd rather call their broker and say, I want to buy 50 OEX blah, blah, blahs, than to call them up and say, hi, Harry, I want to buy 2, options at $35 a piece. It just sounds more macho to say 50 at a steam, Well, let me explain what I mean by this, dealing with deep in the money options. There are essentially 4 ways the market can go once you have made a purchase of a call or a put. First of all, let's suppose the market goes your way in a very big move. Well, the guy who is in out-of-the-money options probably is going to make a really big hit. He's going to watch that option go from 1 to 2 to 4 to 8 and probably one heck of a lot higher. On a percentage basis, he may have made a lot of money. Sometimes, if he waits long enough, the market can have a minor reaction and actually erase most of that gain on a percentage basis. But still, let's give him the benefit of the doubt and say he actually hit a home run this time. Well, the guy who had a deep in the money option still made a lot of money. He watched his option go from 25 maybe to 40. Hey, I'll take 60 or 70% in a week or two. Anytime. Still, he didn't do quite as well as his gambling friend who bought the out-of-the-monies. Now let's suppose another way the market can move is that it will go your way again, but this time small. This time the movement isn't very much. How's this guy doing with his out-of-the-money option? The out-of-the-money option owner, call owner in this case, has watched the market rise, but it's gone up too slowly for him to make any money. You see, strike price is up here. He bought his with the value down here. The market moved, but it didn't cross strike. So the option went out worthless. What about the guy who bought a deep in the money option? It was worth 25 here, and the market goes up an equivalent of 1. His option's worth 1 more, maybe 7/8. Goes from 25 to 26. The market struggles a little higher, and it forces that option up to 27. It forces it up to 28 when it moves 1 point higher. Now, the strike price on the out-of-the-money option is up here. This guy lost 100% of his money. And this guy maybe made 10, 15, 20, 25, or 30%. Now, people who trade in options often sneeze at a 30% gain. Most money managers don't make that much in 2 years. And you can make this very consistently if you'll stick with this particular idea. I know people who do that. Well, the third way the market can develop, it goes sideways, totally flat, from purchase date right into expiration day. The out-of-the-money option goes to 0. It's totally worthless. The in-the-money option, this guy made a bad decision now. The market didn't move the way he thought it should. He paid $25. It had a $1.50 premium. On expiration day, it's worth $23.50. That's not much to give up for a bad decision, for a wrong decision. He's still got 90% of his money intact and ready to try again. The out-of-the-money purchaser has none of his money back, and he's going to have a tough time trying it again. Now, the fourth way the market can go is flat out against you. Well, you might think that both of them are in big trouble, but which one is in more trouble? Which one is in less? The man who bought the out-of-the-money option, of course, watches it go from 1 straight down to about 1/8 and just sits there until expiration day. It goes out worthless. What happens to the option, which was valued at 25, and the market starts to fall? This is a call valued at 25. Well, initially, it starts following the market virtually point for point. 24, 23, 22, but soon the market begins to fall to a level where the premium factor comes into play to help the owner of that deep in the money option. Because options always carry some premium. They can fall right through the strike price, but they don't hit 0 on strike. That option may still be worth $5 or $6, even when it gets back to an intrinsic value of nothing. Maybe 3 weeks before expiration day, this particular option purchaser says, man, that was one of the worst decisions I ever made. My work is now telling me the market's going a lot lower. I'm going to wait for a bounce and get out of this thing. So he sells his option at 5 or 6. But at least he's got some of his capital left. He's got 20 or 25% of his original amount, and the out-of-money option player, as usual, has 0. All of these factors can help the deep-in-the-money options player outwit the market very often, because he's usually only dealing with one variable, and that variable is which way is the market going to go. He doesn't have to worry so much about how far it's going to go, or whether the momentum will be good when it gets there, or what the psychology of the players will be, because that deep-in-the-money option is going to get pushed up and down by the forces of the market itself. Now, there is one exception which I should mention, and that is if you're a professional and you're extremely short-term oriented, where you're trading in and out at least every day, then, of course, deep-in-the-money options are not the right vehicle because they're stodgy. Sometimes the spread between bid and ask can be as much as a point, and that can work against you if you're trading often. If you're trying to catch moves that last several weeks, then deep-in-the-money options are perfectly fine. But if you're trading in and out all the time, the best place to go is the option with liquidity, and that is usually the on-the-money option, and usually the nearby strike, unless it's only a day or two away. So there is an exception, and that's for those people who are sitting in front of a screen all day long and really playing the speculative game. Now, when I started out in the stock market, I had a list of trading rules that I used to carry around in my briefcase, and I'd add one every now and then when I heard somebody come up with a really terrific idea. Number 1 on the list was cut losses short and let profits run. And number 14 on the list was you can't go broke taking a profit. That one was given to me by my broker. Because it encouraged trading, of course. But you see, I began to realize, and it wasn't just these two, it tended to be pairs of these cliches throughout the list that actually were contradictory at certain times during trading. If the market had made a low and I was long a position and it was moving up, was I supposed to let profits run? Or was I supposed to not go broke by taking a profit? Well, in almost every case, you can solve these problems by deferring to your method. Let the method tell you when to get in and out. Don't go with any of these cliches and adages and old traders' tips like that. When I was trading, I guess for a total of about a year and a half, I balled that list up and threw it right in the trash. It was worthless. Each one of those statements was merely a comment on how the last trade would have been profitable instead of generating a loss if I'd just done something different. But it didn't get down to the basics. As you can see, I did conduct some research on how to lose money in the market. I finally took some time to decide what the best way was to make money in the market. And every time I wrote something down, I crossed it out and said, gee, it's not something you can use every time. What are the real requirements? And I started looking around at the people who were successful, and I realized there were only a few basics. Like most things in life, trading is simple in one sense. It only requires a few things. Each one of those may be very difficult to acquire, but they're necessary, and you've got to work to get them. The first thing you need is a method, some method that works. Now, I wouldn't necessarily say that you have to trade using the Elliott wave principle. I think that's the best approach, certainly a very important adjunct, but it's not necessary for success. I know some guys who trade unbelievably well, who make incredible livings from trading, 6 or 7 figures a year trading futures and options and doing nothing else. They don't know beans about the wave principle. They don't know anything about cycles. But they have some method that works, whether it's a sequence of rate of change oscillators or any other type of approach. As long as they have worked with it and assessed it and figured out when to be aggressive and when not to be aggressive, when to have a small amount of their account invested, when to have more, as long as they've worked out something that works for them, they have a method. Now, when I say you must have a method, what I mean is, if someone sits you down and says, I want you to explain your approach to trading to me, you can do it. And what's more, when he comes back 2 months later and says, I want you to explain your approach to trading to me again, you will explain it again, and it will be the same. Now, you may have added a few things that you've learned here and there, but you've identified and defined a method. This is complete anathema to most people. They say, well, I'm bullish because I think so-and-so is going to get elected in November, and I think he's going to do a lot of good things for the country. And 2 months later, he's bearish because he just heard that the third trade deficit in a row came out, bigger than the prior month, and this is a very bad trend to be in. And you see, his method is jumping from one thing to another. He really doesn't have one. He's being pushed and shoved. This, of course, can happen to technicians, too. Well, I'm bullish this month because the advanced decline line is doing this, and the oscillators are doing that. And next month, well, gee, I didn't follow up because the put-call ratio is doing this, and the short sale ratio is doing that. He hasn't sat down and decided exactly what parameters will make him change his mind. And he may feel uncomfortable in the market, but the person who has made up his mind says, I'm sorry, I'm bullish. I know the market's down for the third day in a row after I turned bullish, but my stuff has not turned bearish. It's even more bullish than it was, and I'm not budging. Now he may be changing his approach and being stopped out a few times on a short-term basis, but his opinion is the same. So get yourself a method. Figure out exactly what it is and understand exactly what it is. The second thing you need, and this is almost a cliche, but I couldn't leave it out because it's so critical, is the discipline to follow the darn thing. Most people lack that. They can define their method. When they read it in a book, they understand it. They can even tell people about it. But when it comes to taking the trade, something else influences them. Somebody calls them up and bugs them with a new indicator he's got that disagrees. Something enters the picture which keeps the person from following that approach exactly. It can happen even within the wave principle. Somebody can say, well, the wave structure really tells me that the preferred count, the one I should go with, says 5 waves to the upside have ended. But man, it could be an extension. It could be something much bigger. So I'm going to stick around for a while just to see what happens. What he means is I'm going to risk my money to see if the low probability comes out. He's abandoned his method. So you can't do that. You've got to have the discipline to follow that method. It's seemed to be a little bit more of a coincidence to me that out of the 5 traders that I was able to list a year or so ago as those I felt were the best that I knew, 3 of them were former Marines. Now, that's a pretty big percentage, about 61%, and certainly relative to the number of former Marines in the general population. Now, maybe it is coincidence, but it did strike me that these are people who actually volunteered for an organization which, above all, demands discipline. So whether you consider them the most upstanding people in the world or a little bit nuts for joining, you know that these people said to themselves, I have the discipline to do whatever these people are going to put me through, and I'm going to make it. And those are the people who can take the heat when the market is going, let's say, straight up, and their method is starting to say it's time to buy a put or sell a futures contract short. They're not going to back off. They're going to do it. And they're going to catch the spike high often enough to make it worthwhile. Well, number 3 and last is you need experience. You can't get enough knowledge about trading from reading a book. You can't even get enough knowledge from paper trading. A lot of people suggest paper trading as a way to learn how to do it. I think it's almost a waste of time. Paper trading can tell you whether your method has validity. It can tell you whether your method, applied with discipline, will turn into money. But usually you would know that already if you've developed the method. What does experience do for you? Well, it teaches you how to deal with enemy number 1. And that's yourself. It teaches you how to deal with your emotional side, which is almost always working powerfully against you in your quest for making money. There's an analogy I like to use, and I think it brings this idea home. Let's suppose that one Christmas day, you buy your kid in a computer baseball game. Of course, he doesn't play it. You bought it so you could. And you sit down on the living room floor and you grab that joystick, and pretty soon you're getting pretty good at it. And you're swinging away, and hey, you're hitting home runs left and right. You're fielding great, making triple plays. It takes you a few weeks to get good at it. But you say, man, I'm a pretty darn good baseball player. All of a sudden, through the window comes this giant hand, and the Jolly Green Giant comes in and picks you up. You don't know what the hell's going on. He lifts you through the air and sets you down in the batter's box. You look up at the scoreboard. There's a bat in your hand. It's the bottom of the 9th inning. You're behind by 1 run. There's a guy on base, and the count is 3-2, and the fastball is coming at you 93 miles an hour. And as that ball is speeding toward your face, you can hear in your ears, you're a bum, you're going to strike out, you're going to die, and all this kind of stuff from the fans. Beer cans are hitting the net behind you. You feel different. You're not the genius baseball player you thought you were. You're dealing with a whole host of different emotions. You feel so different. It's 2 different worlds, completely 2 different worlds. And when you're trading, don't have more than 1 phone line, or you get the hecklers calling up. Hey, this thing's going south. You know what I mean? Hey, I heard you were long. You're losing a little money there today, aren't you? Makes you uncomfortable. You don't want to tell your friends you've just lost, 15% on something. Your method is telling you, don't worry, it's going to turn around in your favor. You're still in the right position. All of a sudden, you decide, let me just get another opinion for the heck of it. You call your broker, you call your friend, or your broker calls a client, this kind of thing, and you get other opinions, and pretty soon your method was shoved way over here, and you've eliminated the discipline. But once you have gone through this enough times, well, pretty soon you get kind of cool, you know. You played AA ball, you played AAA ball, now you get the minors and you're in the majors, you know. And pretty soon you've done 1 or 2 World Series. You get up there in the bottom of the 9th, hey, you're under some pressure, but you've been there before. You're not going to flinch. And if that fastball's coming hard at you, you're not going to fall down shivering. You're going to take one good whack at it. That's the difference between paper trading and real trading. You have to live through it to understand the immense pressures that exist. And paper trading, if anything, can be counterproductive because it'll lull you to sleep, saying, oh, hey, yeah, I caught that low, no problem, you know. But try it in real time. You actually have to move your hand, you see, and pick up the phone. And you have to dial numbers. And sometimes it's busy. Or, you know, sometimes you dial 1 or 2 numbers and then you kind of screw it up. You have to hang up. You have to do it again. All this time, you know, you're watching the screen and your 5-minute bars are jerking around like this, you know. And you say, geez, I don't know, maybe he's doing that. All of that enters in. And, of course, if you put your little blinders on and say, I'll stick with the method, I'll stick with the method, I'm going to do this, I've been here before, you'll be successful. There is a shortcut to this. It won't eliminate the problems, but it will save a little bit of time, and that is try to find a mentor if you're not already an accomplished trader. Try to dig around in your own city or your own town for that guy who is a trader, who is successful. He's been trading for 5, 10, 15 years, and the brokers know about him. Yeah, you know, I actually do have a client who makes money. Yeah, they'll admit it eventually, and, you know, get to know these guys. The real good traders are lonely. They don't have any friends to share their opinions with because they're always opposite from what everybody else thinks. So, you know, they're usually happy to sit down and talk to you and teach you a little of what they know. It actually generally makes them feel pretty good. And you'd be surprised. You know, you can approach some guys that you think are, or some women. I know some terrific women players too, who will be happy to take some time and say, you know, why don't you come over for a day and I'll show you what I do. You will learn a lot. Not necessarily of what to do, but mostly of what not to do. So if possible, do that. Find somebody you know is good and go see them. As practical matter, part of the dealing with the experience of it all, I just want to point out 2 things. Number one, taking losses is part of the game. And I think it'll be your biggest triumph if you can manage that. You know, a lot of people say, well, you know, this doesn't work because it was wrong on this trade. Well, hey, every method is wrong sometimes. If you haven't gotten past that point, you're definitely in the wrong business. The question is, which approach gives you the fewest mistakes, the fewest losses? Which approach gives you losses which are the smallest? Which ones gives you the most gain? Which approaches give you sometimes the biggest gains relative to all the others? That is the way to figure out which method is most worthwhile. But regardless of the method, you are going to have to deal with the fact that losses are part of the game. You've got to manage that into your trading. Now, something that almost no one ever mentions is a point that I think is worth saying. It sounds as if it wouldn't be a problem, but believe it or not, it is to most people. And that is, you need the mental fortitude to be able to accept huge gains. Now, a lot of people say, hey, no problem, I want to get rich, you know what I mean? That's the whole point. But really, when it comes down to it, sometimes people don't feel big enough to let a trade really work its way out completely. They did one trade on a futures contract, I made $1,000. They did another trade, they lost $800. Another trade, they make $1,200. They lose $1,500. They make $200. They lose $300. They make $400. They lose $100. Pretty soon they start defining this, you know, 1 to 2,000 area as their range of trading. All of a sudden they're going over their method again, and it says buy. So they buy some futures contracts, and the market goes zip right on the upside. All of a sudden that position is worth $2,000 additional. It goes up another 3 days, it's worth 10 grand. The guy's going, whoa, this is the biggest trade I've had all year. This is terrific. He gets a call from his friend. He says, man, are you still in that trade? Are you nuts? This is the biggest trade you've had all year. If you sell it now, you'll be even. So the guy starts to sweat a little bit. He says, oh, geez, look at this thing. It goes to 11,000, 12,000. All of a sudden, zip, Some bad news hits the market overnight. Gaps down in the opening. He's still got an $8,000 profit. This is the biggest thing I've seen all year. I'm going to take it. He throws in his order. He gets out of the position. Maybe he forgets about it. He comes back a few months later, and then he pulls that chart out again and says, my God, look what happened. And he watched the whole uptrend last all those 3 months, and he calculates it out, and he figures had he stayed with the trade, it would have been worth $104,000. And he let it go. The reason was he had defined himself as a small guy, and he wasn't quite big enough to take it. Well, the answer to that problem goes back to square one. Follow your method, you see. The method didn't tell him to get out. Other factors did. Other things said, well, you know, if you take this profit, then you won't have a loss on the year. You know, such and such will happen on your tax return. And on and on. All these things that may have come into play to his decision had nothing to do with the method. Because the method was watching the chart. And it was market going up and up and up. And finally, right about here, somewhere close to the high, his method said, sell. But he wasn't listening. He was already out. This game of trading, even investing, is tough. It's difficult. You know, the IRS considers earnings from trading as unearned income. I think that's baloney. It takes incredibly hard work. If you're successful at it, you deserve every dime you make. And I wish you the very best of success and luck, too, because that counts, in yours. Thanks a lot.